started, there's a bit of a lackluster market today. You've had a few movements around indices, but there was a couple of FX pairs I wanted to focus on mainly, so that's what I'm going to do. You can see the first one I pulled up is your dollar yen. Now, the reason why I'm going to go over your dollar yen is because similarly to your Swiss yen, which I did the other day, you've got a rallying and rallying and rallying market. And as we know, the dollar is gaining value against the yen is dropping in value, and you've got to do something about it. If you're looking at something like this and you're wondering, okay, well, what should I do? This is probably going to be for you, based on my opinion. Academy member in the chat box, great to see you as well. Don't forget, we've been in correspondence this morning privately, so if you do continue, that'd be fantastic. It's great to have you learning as quickly as possible, but just be careful. You never want to overdo it. I know perhaps some people are keen, but yeah, so you've got your dollar yen. I think if you want the whole story, you go to your 12 monthly. Okay, if you look back from 1970 all the way to 2011, 41 years, you're straight down. Now, it has to be said, if you come down for such a long period of time, you would expect that the rebound would be relatively forceful. So I would say if you were planning on shorting down here, you should have really understood that this was all areas for long entries because of previous price action levels. You can see it's slightly slanted to the upside. But having that as well, I mean, if you take where we've taken the data from and you draw across, your fib level, your retracement is only just gone past your 23.6% fib. Okay, so that gives you a gauge as to how far you've retraced. When you fell, you hadn't even gone probably 18% of the way. So really, the rallies like this are not incredibly unlikely to occur. So first off the bat, if you were going to be trading the dollar yen, you would need to know this information. And that is why I preach so much about going from your highest to lowest time frames. It's not always that your 12 monthly is completely necessary, but it's good to have that background knowledge, because when the markets do rally and rally and rally uncontrollably, it gives you a bit of breathing space and it allows you to be aware that that could very well happen, given that you've just come all this way down for 40 years or 50 years or however long. You would expect you would have some kind of retracement, probably ultimately up until 179. It wouldn't shock me if you get there eventually, whether it takes 1, 2, 3, 5 years, I don't know. But you can see what's happening is on this 12 monthly, you're coming straight back up to the top of that candle wick. Okay, so you've fallen, it's hardly done anything, there's still buy side impetus. Maybe the Japanese won't be too happy about it, and you may see a change. Another Academy member in the chat box, great to see you again from Belgium. I've been to Belgium many times before, and I hope you're well. Again, get me privately if you need any help, and I can answer anything. So yeah, the state of play with your dollar yen, you're pushing straight back into 12 monthly highs. You've hardly had a retracement. There is clearly a lot of buy side impetus, so you've got to adjust something. Okay, you have to change what you're doing, because if you don't, your risk is going to be basically not in line with probability. Okay, and if you're one of those people, and I had a good chat with a member about this today, and he will very well know that. If you're looking at this now and you're saying, wow, this is the trade of the year, it's great. The market is just set up to fall. If it keeps going up, and you say, wow, I've got to take this, I have to do this, I have to get this short. If I don't get this short, I'm going to miss it all. If it just keeps going up, you're going to be terribly exposed. What if we get to 154, we get to 160, and then we get to 170, and you still haven't got your fall? What if that occurs? Okay, you've just got to understand that if you want to be profitable long term, you cannot deviate your risk. Right? You have to keep the set plan. The second you change your risk and your coordinated reward, you get a skew in data. And that's why it all comes down to statistics and variance. And that's mainly how I teach trading from a mathematical perspective. It's basic mathematical principles, really, when you look at it. But that is how you destroy the factor of emotion. People get emotion because they change their risk, and ultimately that changes their reward. Okay. An example of that is shorting here, shorting there, shorting there, shorting there, just slamming loads of positions in because you're hoping for a large fall. If you don't get it, then you can't handle the move and you'll never make any money. Okay. So you've got to change your risk attitude so that you can survive this. And ultimately, when it does fall, you're still in the game and you've made money overall. Okay. That's why I teach people to hedge accordingly. If you don't know how to do that, don't try it on your own because I'm telling you, it will not work. If you try to do this yourself with no guidance, you will lose money. Okay. So just know that. The central bank speeches, what is the probable effect? Well, the thing is with market news, there is no probable effect. Someone as well, actually another Academy member, had a very long chat with me yesterday. He was saying what was probable. He said, oh, it's probably going to do this or probably going to do that. The fact is, nobody actually knows. You can only put the likelihood up more so, but I don't know what the probable effect of any news event is ever going to be. Nobody does. Okay? If we knew the probable effect, you'd be able to trade accordingly. All I'm interested in is the fact that the market moves, because that gives me the opportunity to take high or low prices. That's it. So I have no idea what the news is going to do. I will only and actively trade the reaction as it comes. Today we've got Bank of England Governor Bailey's speech. We've also got a Fed Cook speech for the US at 10:15 a.m., so a couple of hours, I think. And then you've got Fed's Jerome Powell at 2:15 for the US again. So they may say 50 different things, but at the end of the day, all we're interested in, for example, is being short and exiting at the right time via your dollar yen. I would imagine ultimately you may come back to this level of key price action. Otherwise, if you do keep going up, the only thing you can really do is inherently lower your risk so that you're prepared for continuation up. And like I said, really, when you think about it, is it really a massive shock that you've had this rally given you've come down? I mean, you can't even see it when the way I've organised the screen. But if you look how far you've come down, is it really a shocker that you've got this big rally? I don't think so. Therefore, I think you may find you've got further room to. So just be aware of that. You shouldn't be upping your risk. It looks like it's coming very quickly off these low key moving averages, just like it has for an extreme amount of time now. Therefore, it's strongly uptrending. Most of the time, if you can't break your 20 or 40 MA, there is clearly not enough sell impetus. So be very careful. If you're going to reshort it, I'd probably do it above this or around this. I probably wouldn't do it just yet, just based on how forceful price is at the moment, which you can see right here. You can see that this fall has practically done nothing. There's no real smasher move. So long term, I think you will get that bigger fall. That's my bias. I'm only interested in buying it on a larger fall back to these key moving averages on your weekly time frames. Nonetheless, I'm keeping my risk under control. I'm never stepping it up. I only lower my risk. Okay. It's important to understand that you should only ever lower risk. You should never up your risk past what you find appropriate. Because once you get to a point where the market come down for 40 years, then it starts to rally. You just will not be able to deal with it because you're changing the results over time. You're skewing the results naturally by putting your risk up. Okay, it's like betting like $5 and then betting $1,000. Obviously, your win and loss is going to go like this because you're either going to win the bet or lose the bet. Okay, so you have to go along the lines of probability long term. So that is the dollar yen. Don't forget to get my free training underneath and like, share, comment, subscribe, follow me wherever it is you are watching from.